Hi everybody, and welcome to the London session update with myself, Kathleen Brooks, on Thursday the 8th of August 2013. Well, it's been a very interesting 24 hours. We've heard from Mark Carney, we've got forward guidance in the UK, we've seen some huge moves in the FX market. So what is actually going on? Well, this time yesterday, if you can cast your mind back 24 hours, you'll remember that dollar yen was falling. However, it was only dollar yen that was falling. Basically, the dollar was holding on to everything else, and we thought we were a little bit skeptical of the dollar yen move, thought that maybe because the dollar was gaining strength elsewhere, it would be temporary. Well, alas, that was the wrong way to take it. We got the wrong end of the stick there. Instead, that dollar yen decline lower, decline below 97 was really a precursor to a lot of dollar weakness elsewhere, and the dollar has really taken a pounding. Now, on that note, let's look at cable. So this is sterling versus the US dollar. As you can see, absolutely shot higher, really reversed that recent weakness back to kind of month highs, looking very, very strong. We had the less radical than expected inflation report from Mark Carney yesterday. It's forward guidance light, really. I think the market really understood what forward guidance was yesterday for the first time. So forward guidance doesn't necessarily mean a change in policy. It's more a change in policy explanation. So the Bank of England didn't pledge to do anything. They didn't pledge to keep interest rates very low. There's just some different unemployment thresholds that if we reach that level, then it may signal a rate rise. But it's certainly nothing is set in stone. And the way that the economy is going in the UK, whereby economic data is really starting to pick up now, a rate rise could be sooner than we think and sooner than the Bank of England thinks, and that's what's really helped propel the pound. We've seen 2-year yields. Remember, they rose very sharply on the back of that inflation report yesterday. At one point, they were stronger than they were from before Carney even joined the Bank of England. So really, whatever the bank was trying to get, if its aim was to reduce short-term government bond yields yesterday, it didn't manage to do it because yields are still fairly high now, still back at kind of 6-week highs. On the very close to 0.4% on the 2-year. So Carney may have some more work to do, but that certainly has helped cable. As you can see, we've got a very key resistance level coming up. It's absolutely huge, in fact. It's 155.40. Now that is the 200-day moving average. It's the yellow line on your chart. We've been attempting to get above there and we've been rebuffed back so far, but we do think momentum is still to the upside. Remember, there was a lot of dovishness about Mark Carney really priced into the markets. Combine that with a dose of dollar weakness at the moment post that weak payrolls report on Friday, and we could see cable really get above this level, and then it would open the way to kind of 155.5, obviously, on the way to kind of 156, and even those 157.20 highs that we saw back in June. Now, obviously, dollar yen has also been a big mover, and interestingly enough, dollar yen downside has really been exposed. As you can see in this chart, we are now well and truly below the cloud. We lost that 98.30 level, which is the cloud base, and we've slipped through 97 yesterday, and we haven't managed to get back up there. We have heard that there is rumoured option-related buying interest at 96.15. That's really cushioning the downside for now, and 97.50 would be the first kind of resistance level that we'd look at, or key resistance level that we'd look at that would maybe signal a recovery. Right now, dollar yen though looking very, very weak, and what's been interesting is that dollar yen has been able to shrug off some hawkish comments from some Fed speakers this week who are all very supportive of tapering. I think it goes to show yet again that tapering asset purchases does not mean that it's positive for the dollar, because interest rates are still going to remain very, very low, especially if job growth starts to slow. So that payrolls report, the main theme at the moment seems to be weak payrolls equals weak dollar, and we could just grind lower in the dollar again. You know, for example, with this dollar yen move, we really are now. If we do get below 96.15, it does open the way to a move sub 95, where we haven't been since 20th of June. So okay, everyone, watch out for that. Dollar still looks vulnerable in our eyes for the short term at least, but do watch what cable does as well, and whether or not we can get over that huge hurdle and see further gains. But please join us soon for more. Thank you very much.